I say that as far as gold is concerned, China is like a Hotel California. Once it goes in, you don't see it again.
Right.
I mean, I did an exercise trying to work out how much gold the Chinese had before 2002, when they then set up the Shanghai Gold Exchange and permitted their citizens to buy gold. In fact, they advertised and said, gold is good for you, or whatever the byline was. And the result is that since 2002, the citizens have acquired something like 27,000 tons delivered through the SGE. Now, that's a gross figure, because what I haven't seen is details, if you like, of scrap going back into the SGE's vaulting system. But I think, we're probably looking well over 25,000 tons, I should say, are in private sector hands. Now, the reason that they started to permit for the public, if you like, the Chinese citizens to buy gold in 2002 was it was quite clear that the state had acquired enough of a stake for it to be satisfied, and therefore not to be acting in competition with its own citizens in acquiring gold. And you need to go back to 1983, when the regulations were put in place for the People's Bank of China, was appointed then to acquire the nation's gold and manage the nation's gold reserves, and also silver. And that was 1983. Now, bearing in mind that from that time going on to 2002, there was a massive bear market in gold, which took it down from, we're talking about something like $600. It had been higher in 1981, but something like $600, $500 down to half that. A lot of gold was sold out from the West. And not only that, but there was a lot of gold leasing going on, where gold was disappearing into the market and not going back into central banks' coffers. This was estimated by Frank Veneroso in 2002 to have totaled somewhere between 10 and 16,000 tons. Now, he said at the time that he thought that this had ended up round the necks adorning Asian women. Some of it, I'm sure, did, but I think the bulk of it actually went into China. I reckon that by 2002, she had acquired between 20 and 25,000 tons of gold. Now, bearing in mind that ever since then, the policy has continued of not allowing any gold to go out of China. In 2014, I interviewed a director of one of the Swiss refiners, and I asked him whether he'd ever seen any Chinese refined bars, and he said no. I asked him the same question about 7 years later, and he said, well, I heard reports of a few, but we guess they were smuggled out. So you can see that nothing comes out of China. And as you rightly point out, they've accelerated their mine production. They import doré from elsewhere, particularly silver, and refine it, doesn't go out. The only part of China where there is any sort of free trade in gold is Hong Kong. But an awful lot of that, some of the gold from Hong Kong, I think, is released through from China. But basically, that is more or less matched by the people on a day trip to Hong Kong, walking into the shops in Hong Kong and buying gold jewelry. And they take it back, having saved sales tax of something like 20%. So China has accumulated a hell of a lot of gold. Now, how much she's got since 2002 as a nation, I honestly don't know. But I think we could probably, from her mines and various other sources, we could probably say that it's there's another, possibly 10,000 tons. So what we're looking at in China is we're looking at probably 30 to 35,000 tons in the hands of the government.
When we talk about the global gold market, we must discuss the quiet but monumental role that China has been playing. China has been strategically acquiring gold for decades, but unlike Western nations, which operate with more transparency, China's approach has been a closed-door affair. The sheer volume of gold the country has acquired and continues to acquire places China in a very unique position in the global economy. If gold represents financial power, then China is preparing to take a leading role in the future of global monetary policy. Back in 2002, China took a major step by setting up the Shanghai Gold Exchange, SGE, allowing its citizens to start purchasing gold. Before this, gold ownership was highly restricted, with most of the metal being accumulated by the Chinese state. The government had its reasons. By the time the exchange opened, China had already amassed a significant gold reserve, providing a level of financial security and international leverage. Once the state was satisfied with its gold holdings, it shifted its focus to encouraging citizens to buy gold, signaling a long-term strategy to fortify the nation's wealth in a tangible asset. The government even ran public campaigns promoting gold ownership, effectively telling its citizens, "Gold is good for you." The results of this initiative have been staggering. Since 2002, it's estimated that Chinese citizens have acquired around 27,000 tons of gold through the SGE. While this is a gross figure, and it's likely that some gold has been recycled back into the system, we can reasonably estimate that well over 25,000 tons remain in the hands of private Chinese citizens. This is an extraordinary figure, and it underscores the cultural and strategic importance of gold within China. But why did China make such a bold move to push gold ownership among its citizens? The answer lies in the state's confidence in its own gold reserves. By 2002, the Chinese government had likely already acquired enough gold to secure its financial future. The groundwork for this accumulation began in 1983, when the People's Bank of China, PBOC, was given the mandate to manage the nation's gold and silver reserves. From 1983 until the opening of the Shanghai Gold Exchange, China was quietly buying gold, taking advantage of a massive bear market that saw the price of gold plummet from around $600 per ounce to nearly half that by the 1990s. During this time, gold was being sold off by Western nations and central banks, many of whom were more focused on managing their fiat currencies. In fact, a significant amount of gold was being leased out by Western central banks, with the understanding that it would eventually return to their vaults. However, much of this leased gold never made its way back. Frank Veneroso, a well-known gold analyst, estimated in 2002 that somewhere between 10,000 and 16,000 tons of leased gold had been absorbed by the market. While some of this gold undoubtedly ended up as jewelry adorning the necks of Asian women, a substantial portion likely found its way into Chinese coffers. By 2002, China had likely acquired somewhere between 20,000 and 25,000 tons of gold. This accumulation positioned the country as one of the world's largest holders of gold, even if it wasn't publicly acknowledged. What's more, since the establishment of the Shanghai Gold Exchange, none of this gold has left China. In fact, it's widely known that gold refined in China stays in China. I remember speaking with a director from a Swiss refiner in 2014, asking him if he had ever seen any Chinese refined bars, to which he responded, no. Years later, he confirmed that he had heard rumors of a few Chinese bars making their way out, but those were likely smuggled. This tells us that China has a strict policy when it comes to keeping gold within its borders. But China's accumulation of gold doesn't stop at what's mined domestically or purchased through international markets. The country has ramped up its domestic gold production, becoming the world's largest gold producer. Additionally, China imports unrefined gold from other nations, particularly silver d'or, which it refines domestically. Once refined, this gold never leaves the country, adding to China's already substantial reserves. If we include the gold that's been mined and imported since 2002, it's likely that China now holds between 30,000 and 35,000 tons of gold, making it a dominant player in the global gold market. This vast accumulation of gold serves as a foundation for China's future financial strategy, one that is likely to challenge the dominance of the US dollar and other fiat currencies.
The other thing, which is a more recent event, is that banks have been instructed to offer gold accounts to their customers. And what this means is that if you've got a bank account with, one of the main Chinese banks, then you can equally deposit your yuan into a gold account. And then you have got an account which tracks the price of gold. Now, bearing in mind that China is a high savings-driven nation, they reckon that household savings amount to 35% of GDP. Now, that is the equivalent of $6 trillion. Property is not absorbing any of this anymore. They can't go and buy foreign investments because of exchange controls. The stock market has been pretty poor for the last 3 years, in contrast to what's been going on in the West. I mean, it's picked up this year a bit, sure, but not enough to persuade Mrs. Wong or whatever the housewife may be called, to go and buy stocks. But her bank offers a gold account. And so the bank then has to go out and buy gold. And I think this is what we're seeing at the moment in the gold markets. We're seeing the stands for delivery on COMEX alone have been over 2,000 tons since 2021. I mean, it's a fantastic number. On top of that, you've got deliveries out of London. So, any spare gold is basically being siphoned off to the east. And of course, it's not just, the Chinese housewife bank account, bank therefore in the market, but it's also India. And they've recently removed, now you may ask why, but they've recently removed the tax or cut the tax on gold down to something like 5%. India started buying gold too, after a long period of not doing anything at all. Why? Because she knows that the way the Shanghai Cooperation Organization is going and BRICS, gold is going to be the future. The days of fiat currencies are rapidly drawing to a close, so she's got to have gold. She's very Keynesian in her approach, but even she sees, it would be a bit silly for us not to have any gold under these circumstances. This is something that I think, Jay, is going to continue until the system breaks. And when we see gold being just incredibly stable at $2,500, I mean, that just tells me that there's big money in there buying the dips, and it never goes further than maybe $10, $20 below the 2,500 level.
Right.
There is a big buyer in there. And my guess is it's probably China's got something to do with it. If not China, then her associates, the central banks, whatever, around the Shanghai Cooperation Organization and BRICS.
In recent years, China has also encouraged its banks to offer gold accounts to their customers. This move allows Chinese citizens to deposit their savings into gold-denominated accounts, giving them direct exposure to the price of gold. Given that China has one of the highest savings rates in the world, with household savings estimated to be around 35% of GDP, this is a significant development. In dollar terms, this represents approximately $6 trillion in savings. And with property markets cooling and restrictions on foreign investments, many Chinese savers are turning to gold as a safe haven. The Chinese government's promotion of gold accounts is particularly interesting because it forces banks to purchase gold to back these accounts. This increased demand is one of the factors driving up gold prices globally. And it's not just China's citizens buying gold. Other countries, particularly India, have ramped up their gold purchases as well. After a long period of inactivity, India has recently reduced taxes on gold imports, signaling that it too recognizes the importance of gold in the future global financial system. India's re-entry into the gold market is significant, especially given the rise of the Shanghai Cooperation Organization, SCO, and BRICS nations. These organizations are working towards creating a new financial system that is less reliant on fiat currencies like the US dollar and more focused on tangible assets like gold. For countries like India, which have historically been major gold consumers, ensuring they have enough gold to participate in this new system is crucial. What we're seeing now is a global shift towards gold, driven by Eastern nations that recognize the fragility of fiat currencies. As central banks around the world continue to print money and devalue their currencies, the appeal of gold becomes more apparent. And with the price of gold holding steady at around $2,500 per ounce, it's clear that big players are buying the dips, keeping the price from falling too far. Who are these buyers? It's likely that China is one of the largest, if not the largest, buyers of gold on the market today. If not China directly, then it's her associates within the BRICS nations and the Shanghai Cooperation Organization. These countries understand that the days of fiat currencies are numbered, and they're positioning themselves for a future where gold plays a central role in global finance. The role of gold in the global financial system is evolving, and China's strategy is a testament to this. As fiat currencies face increasing instability, gold is emerging as the one true store of value, immune to the whims of central bankers and inflationary pressures. But China is not alone in recognizing this. Across the globe, other nations, particularly within the BRICS alliance, are also stockpiling gold, preparing for a future where tangible assets, not paper money, will dictate economic power. One of the reasons we're seeing such a surge in gold purchases is the growing awareness that fiat currencies are on borrowed time. For decades, the US dollar has served as the world's reserve currency, but its value is no longer backed by anything tangible. Central banks have been printing money at unprecedented rates, leading to inflation and a devaluation of the dollar. As a result, nations are turning to gold as a hedge against the inevitable collapse of the fiat system. China's strategy of accumulating gold while keeping it out of the Western financial system is brilliant in its simplicity. By refusing to allow gold to leave its borders, China ensures that its reserves remain intact, even as it continues to import and mine more gold. This is in stark contrast to the West, where gold reserves have been steadily depleted over the years. China's approach is one of long-term thinking, positioning itself to become the dominant economic power in a world where gold once again serves as the foundation of the global monetary system. As we mentioned earlier, China has accumulated between 30,000 and 35,000 tons of gold, but it's not just the state that holds this wealth. Chinese citizens, encouraged by their government, have also been buying gold in record amounts. The introduction of gold accounts by Chinese banks has further fueled this demand, as savers look for ways to protect their wealth in a world of declining fiat currencies. But China's gold strategy isn't just about accumulating wealth, it's about preparing for a new financial order. In the future, we may see a return to the gold standard, where currencies are once again backed by tangible assets like gold. The BRICS nations in particular are working towards creating a new financial system that is less reliant on the US dollar and more focused on real assets. This would represent a seismic shift in the global economy, and those who are holding gold will be in a position of strength. India, too, is preparing for this shift. After years of staying on the sidelines, India has recently cut taxes on gold imports, signaling that it recognizes the importance of gold in the future global financial system. India, along with China, is one of the largest consumers of gold in the world, and its re-entry into the gold market is a significant development. Meanwhile, Western nations seem to be lagging behind. While central banks in the US and Europe continue to print money, devaluing their currencies, countries in the East are quietly accumulating gold. The West's focus on short-term profits and financial engineering has left it vulnerable to the coming shift. When the fiat system finally collapses, those holding gold will be the ones with real power. In conclusion, the global gold rush is not just about hedging against inflation, it's about preparing for a new financial system where gold and silver play a central role. China, India, and other nations within the BRICS alliance are positioning themselves for this future, quietly accumulating gold while the West focuses on propping up a failing fiat system. The days of fiat currencies are numbered, and those who recognize the value of gold will be the ones who thrive in the new global economy. For those of us watching this unfold, the message is clear. Gold is not just a commodity, it's the key to future economic power. As nations around the world continue to accumulate gold, we must ask ourselves, are we prepared for the coming shift?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.